How's it going, everybody? It's Stas here. So in this video, we're going to be doing an M1 Finance portfolio update. It's been about 3 weeks since my last update video, and I want to go over exactly what I've been doing as of late. What stocks have I been buying? I actually sold out of a position. I want to update you guys on that, and I also want to let you guys know where my head is at right now. I mean, we're in a point in time, historic time period right now. Markets are soaring to all-time highs, while the economy is not doing so great, right? We're still in that period where we're struggling, and we're seeing a bit of a detachment from reality in the in the stock market, right? And as we're seeing this, again, I want to go over exactly where my head is at and kind of how I'm navigating these waters as a long-term investor. And again, I trade. A lot of the stuff we talk about on the channel here is about trading short-term stuff in the market, but what you're watching here, this is a long-term portfolio. I'm talking 5 to 10 plus years out. And for all the new viewers out there, maybe you're new to the channel, this is something that I started a little bit over a year ago, back in the beginning of July of 2019 with $0 here on M1 Finance, and I've grown it up to where it is now. And my plans are to make this portfolio even bigger in the future, and honestly, in the next 2 years, I want to get this thing to 6 figures, $100,000. That is the goal of this portfolio. And in general here, this portfolio is comprised of a lot of different stocks. And if you guys, before we get into it, if you guys find value in the video, I'm sure you will, hit that like button for me, consider subscribing to the channel, and check out all the free links down below in the description box if you want to be a part of our community. And again, this portfolio is long-term, and it's comprised of stocks that are growth stocks, growth-oriented, and for the most part, dividend growth-oriented stocks here. And before we get into exactly what I've been doing as of late, let's just run through what I have here in my portfolio. Overall, it's about $5,100, and 3 weeks ago, when I did make my previous update video, I think it was around $4,200. So in the past month, I mean, we've made about $80, 71 being from market gains, $10 being from earned dividends. And if you guys actually want to see where the portfolio started and all the episodes before this one up until this point, make sure to check out the playlist down below in the description box. That's where you can see all of these videos, and you'll see again how it got from $0 up to about $5,000 to where it is today. And as we scroll down a bit, you can see it's comprised of around, I believe, 19 stocks, this portfolio here, 19 stocks. And the beauty of M1 Finance is you don't need to have a ton of money to actually own 19 stocks, because you can actually buy individual companies with fractional shares. A lot of brokerages are starting to do this these days, but a lot of them still don't do it. So that's kind of an advantage here of M1 Finance if you do want to have some more holdings, a bit more diversity with a smaller amount of money, right, at about $5,000. Because back in the day, if you had $5,000, and with all the fees back in the day, there's no way you could have 20 holdings, without fees eating you up and just without, the fractional share option, unless you do a drip through a traditional brokerage, but that's a bit different, and we won't get into that rabbit hole in this video. But either way, this is what we're seeing right now in M1 Finance, $5,100. My top holdings at this point are DGRO, DGRO, and SPHD. These are 2 ETFs, and they're kind of the base of this portfolio, 10% each. And the truth is, guys, I want to phase out SPHD, not completely out of my portfolio, but from 10% where it is right now, I kind of want to phase it down to about 5% of my portfolio, which is why you guys see it here. It's currently 10%, but the the target is 5%. So over time, the way I'm going to phase it out is I'm going to add more money to other positions. I'm going to add more money to the bottom of my portfolio, to the underweight holdings potentially here, maybe Procter & Gamble, Facebook, maybe VEA is another ETF I might add to. And as I do that, it's going to balance out the top and eventually bring SPHD closer to that 5% figure. And DGRO is a dividend growth ETF, and this is going to stay around 10% of my portfolio. And mind you, SPHD is actually a low volatility, high dividend yield ETF. And since this is more of a dividend growth portfolio, that's kind of why I'm dropping down the weighting of this low volatility ETF and keeping DGRO as the base of the portfolio. Then under that, we have Johnson & Johnson. We have Starbucks, which I just added to the portfolio, guys. We'll talk about that in a couple of minutes here when we go through my buys. Under that, we have Realty Income, and these are all dividend growth plays. I mean, other than Realty Income, I have to double check and see how quick they grow their dividend. I mean, Starbucks is a dividend growth play. J&J is a dividend growth play, meaning they grow their dividend very quickly, and they also have been paying dividends for years. I know Johnson & Johnson is a dividend king, meaning it's grown its dividend for 50 plus years in a row. Starbucks has actually grown its dividend for 10 years in a row, and I believe it's going to grow it for many more years into the future here. And Realty Income, again, ticker symbol O. This is a monthly paying REIT, which is a real estate investment trust. And then under that, we have Disney. We have ticker symbol DIS, which I believe in the long term, despite everything going on right now with the whole crisis, with the whole CV, I'm still buying Disney and I'm adding to my position because I believe it's going to come out on top. The brand will not die, and I believe Disney Plus is going to deliver some pretty good results in terms of, these next couple of quarters, and the growth there, I believe, is going to be stellar heading into the future. Then under that, we have Microsoft, MasterCard, both dividend growth companies and growth companies in themselves. And again, you guys can tell and you can see the types of companies that I have. A lot of them are low paying in terms of yield, but they're growing the yield very quickly. And the businesses themselves, they're not zombie companies. I mean, there's a lot of growth in these businesses left. Then under that, we have Amazon, which does not pay a dividend, but it has a lot of growth, so I figured I'm going to add this to my portfolio as well. And another note, not every stock in this portfolio pays a dividend. I think 15 or 16 out of the 19 do, but not everyone pays a dividend. Under that, we have Altria and AbbVie, two very awesome dividend stocks here with some nice growth prospects in the future, especially AbbVie. We have Altria trying to get into the MJ space. I think that will be successful later on in the future, maybe 5 years from now. And AbbVie, with all their drugs, their patents, this is a very strong healthcare company to own, in my opinion. Both very strong dividend plays. And under that, we have Pepsi, McDonald's. We have VEA, which is a Vanguard Developed Markets ETF, Duke Energy, PayPal, AT&T, Facebook, another one that doesn't pay dividends. Same thing with PayPal, right? And then Procter & Gamble at the bottom. So this is kind of what my portfolio is looking like at this point, guys. $5,100, 19 holdings. And if we take a look at the holdings themselves, I mean, most of these are doing pretty well. I mean, out of all of them, my best holding in terms of return is going to be Amazon at about 48%. Actually, no, if we're taking a look at dollar return, which I like looking at percentage return more, I mean, dollar return, Amazon's the most, but in terms of percentage return, I don't even know if we can filter for that. But either way, we can see, if we just take a quick glance, percentage return, the best is PayPal, followed by Amazon, then Microsoft, Facebook, J&J, and AbbVie. So those are the top performing holdings in my portfolio. And you guys know the market's not all sunshine rainbows. I mean, I have some red stocks as well. DGRO, the ETF that's at the top, I mean, I'm down overall on that, 0.4%. VEA down 2%. Altria down 2% overall. And let me make sure this is all time. Yes, it is. And AT&T down 13%. Disney down 8%. Realty Income down 9%. SPHD down about 11%. So that's kind of how I'm doing overall right now in my long-term portfolio. And going over here to activity, you can see my trades, my buys, my sells, and all of the deposits I've made so far in July. So you guys can see here, I mean, I've been buying stocks all of July, stemming back from the beginning of July. I mean, I bought a lot of DGRO, Pepsi, PG, AT&T back in the beginning of July. We can see another bulk of buys here. I bought Pepsi, Procter & Gamble. This is when I started initiating my Starbucks position. And let me tell you guys, in my opinion, Starbucks is one of those companies that as we get out of the crisis, I think they're going to bounce back the strongest. And that's just my personal opinion. I think a lot of these restaurant stocks, I mean, obviously they've been hit a lot, some more than others. You know, I think a lot of them are going to bounce back and be very strong. And Starbucks is in a position where its growth plan is intact, in my opinion, long term. It has more of a tech exposure to it at this point. You know, with the drive-through process, their whole business, it seems like, is dialing in. You know, they're becoming more cost effective. And their stock price, I mean, if we're taking a look at it, if I pull up my ThinkOrSwim very quickly, their stock price, SBUX, I mean, it's down from about $94 down to about $74. So if we're looking at all-time highs here on Starbucks, we're 20% under those all-time highs. Actually, no, I'm wrong. Let's go back even before that. 99 is the all-time high, not 94, 99. And from there, we're down about 25%. So I'm thinking, guys, as the economy gets back to normal, and guys, it's going to get back to normal. This crisis, it's going to end. CV is going to go away. There's going to be a vaccine. We will get back to normal. Probably not in the next couple of months. It might take 2 years, a year or two, but again, this is a long-term portfolio. I think when that happens, Starbucks is going to explode. It's going to be back up above 80, 85, even 90, 95. Honestly, I think Starbucks is going to be $100 in a couple years. In 2-3 years from now, I would not be surprised if Starbucks is $100 per share. So that's why, you know, I'm not loading the boat at this point, but that is why I'm adding into it slowly. And quite honestly, I plan on continuing adding into Starbucks as long as it's under $85. I'm going to be buying it. And as it gets above 90, I might slow down a bit and start accumulating the dividends and maybe reinvest somewhere else. But honestly, guys, again, I think Starbucks is poised to bounce back very aggressively as the, you know, world gets back to normal over the next, you know, 12 to 18 months. And you can see some more deposits here. I mean, $60, $50, you know, 4 buys here on 13th of July, you know, 16th of July, another $50, you know, 21st of July, $300, and ended up buying, you know, on this, that was actually yesterday or the day before of me filming this video. I bought $300 worth of stocks and 5 different buys here. I bought $50 of DGRO, $50 of Pepsi, $50 of Disney, $50 of MasterCard, and another $100 of Starbucks here. And another thing, guys, about long-term investing, I mean, it's not glamorous. It's not the funnest thing. It's not sexy, right? I know trading in the stock market, day trading, swing trading, it's more sexy, whatever you want to call it. It's more fun. And a lot of the time, guys, I mean, this is what it is for long-term investing. You just have to be diligent with it. You have to continue adding money, continuously buying throughout the months. Then long term, you're looking 5-10 years out, you're going to look back and be like, holy crap, I've built a pretty big portfolio. So that's kind of what's been going on. And I also ended up selling out today of 3M. That's the position that I ended up cutting, and I ended up adding even more to Starbucks. So I kind of kicked out 3M, and I ended up adding Starbucks to my portfolio. And this kind of goes back to what I said earlier in the video. I don't want to focus a lot on zombie companies in this video. And by that, I mean companies that are just dragging along. They're not growing too much. And 3M, not kind of throwing it under the bus. I mean, it's a great dividend stock out there. If we take a look at quickfs.net, and they don't sponsor this video, this is a website that I use for personal use, and I've been using it for a while for financial information. You get 10 years of data of information here, which is great. If we take a look at 3M, I mean, on the top line of their business, if we're just taking a look at revenue, they have not grown. They've grown barely since 2010. 2010, they did 26 million or billion in revenue here. Or is this? Yeah, it's in millions. 26 million or billion in revenue in 2010. In 2019, they did 32 billion. So there's no growth there. There's literally no growth there. Yeah, there's a dividend. They're a dividend king. They've been paying and growing for 50 plus years. But truth is, guys, me being a younger person, I see a lot more potential in Starbucks as opposed to investing in 3M. That's kind of the mentality that I'm, transferring into this portfolio and just focusing a bit more on growing companies that also pay a dividend that's growing. And take a look at Starbucks, right? Again, 3M, no growth, very slim growth at that over the past 10 years. But when we pull up Starbucks here, SBUX, take a look at their growth. I mean, back in 2010, they did $10 billion in revenue, and in 2019, they did $26 billion. So they almost 3x'd in the same time period as 3M barely moved. So I'm not knocking 3M, guys. I'm just saying this is why I added Starbucks into the portfolio. Yeah, they don't pay as much dividends now as they do as 3M does, but in the future, as the company continues to grow, they're going to pay more dividends. That's why it's called a dividend growth company. And feel free to use this, guys. Go to quickfs.net. I mean, again, it's not sponsored. They don't sponsor this video at all. This is a very good website that I personally use, and I figured, let me tell you guys, and help you out, because it really helps me when it comes down to looking at key numbers, especially for long-term investing, because with trading, it's more technicals, a lot of technical analysis, but with long-term investing, you have to dive deeper into the balance sheet, income statement, cash flow, look at fundamentals, where the business is going, and so forth, right, guys? So, yeah, that's pretty much it for this video and the update for the M1 Finance portfolio. I hope you guys enjoyed it. If you did, hit that like button for me. Consider subscribing to the channel. And if you guys actually want to join and open an account with M1 Finance, check out my affiliate link down below in the description box. If you actually sign up using my link, you get $10 by simply, I believe it's depositing any amount of money, and I also get $10 for you using my link. And this is not a trading brokerage, guys. Keep that in mind. This is only for long-term investing. So if you're interested in long-term investing, dividend investing, even long-term growth investing, this is a great brokerage. Again, I've been on it for over a year at this point, and I've loved it. Really no complaints whatsoever. So yeah, get your $10. That's linked down below. I'll catch you all in the next video. Stay safe out there as always. Peace out.